Zack.
Die Stummschaltung ist aufgehoben.
Good morning, guys. Good morning. How are you? Can you hear me? Is the screen okay? And can you hear me okay? Hi, Hendrik. Working or not working?
It's working.
It's working.
It's working.
Super. Communication issues in our relationship. All good. I hope you guys had a wonderful weekend. Hope you made some money last week. VT, good to see you. Alex, Dees, Rolf, great. Okay, let's go. Disclaimers in full effect as always. And what did we have going on from last week? Okay, we still had the opportunity short euro dollar. I reiterated the reasons here for us to refresh our memories. We had very weak PMIs out of Germany and France. We had some ECB members even stating that the economic slump may be in effect, stronger than they had anticipated. And then on the dollar side, we had what's called the dollar smile in effect, which actually may be getting priced out of the market this week. So be careful with dollar strength. This week might actually see a bit of weakness potentially. We'll have to see, because today is Monday. Monday is construction day. We get into position for the campaigns for this week. And on Friday is the square up day, where at least the position and swing traders are taking some of their positions off, not willing to carry risk into the weekend. So on that trade, that was on the 25th of March, our initial scenario where we were hoping for the euro to see some strength. Also based on commitment of traders reports that we may head into what's called the role reversal. We didn't quite get there. And that's quite sad that we don't have like a real-time alert service where I could text to you guys where I'm making some changes. I did make some changes. I entered the trade. Obviously, I mean, it was my trade of the week, so obviously I entered short and made some money off of it. So did a lot of my traders. Anywho, headlines this week. We had Asian equity screen on positive risk tone. That carried over from Friday, over from Wall Street, which closed positive. And then overnight, we had some better than expected Chinese PMI data, i.e. the official data, as well as the Caixin, which used to be the HSBC. On the China-US trade talk front, we continue to get a little bit of mixed messaging. For my personal interpretation, I'm seeing a bit more positive sound bites than negative. And my personal interpretation at the moment is that the Chinese need the deal less than the US, i.e. Trump. So I personally am hopeful that we'll finally see a resolution to the saga, because it is dragging on global growth, and especially, unfortunately, on German manufacturing as a second derivative impact. And we saw that again this morning on very weak German manufacturing numbers. Brexit, the saga, unfortunately continues as well. The pound is seeing some strength this morning. I don't know if you even are looking at fundamental data any longer. I did, and I observed that construction spending, i.e. the construction PMI, was quite strong in the UK this morning. Unfortunately, the flows are and liquidity are based off of Brexit headlines, and that is really on a minute-by-minute basis. Almost Twitter is exploding, and so are the headline feeds. What can we say? Well, for sure, there's going to be further indicative votes this morning. I had a conversation with my co-instructor this morning on pound. She's switching from bearish to bullish, and I personally remain on the sidelines. I am very, very conservative when it comes to managing money, and I'm not a proponent of gambling. I really like to put my odds in my favor before I enter at risk, and then I manage risk closely. And the pound, I'm unable to predict the behavior of politicians. And I might state that I'm of the opinion that neither can artificial intelligence. So I have no clue what the algos are doing, and I have no clue what the outcome will be in terms of the Brexit votes this afternoon. It seems like the more measured solutions are gaining more support, which would then obviously yield and result in some pound strength. So if you're eager to trade that, keep an eye on the headline feed. Do not, under any circumstances, trade this without. is my suggestion without a live headline feed. It's just too dangerous. German final manufacturing came in, as I alluded to early on, at 44.1 versus 44.7, and the qualitative input here was interesting. More and more firms reporting lower demand linked to Brexit and trade uncertainty. So Brexit, we have it on the headline, trade uncertainty, that is the US-China trade war. Troubles in the automotive industry, that is the potential US prohibitive fees for German exports into the US automotive industry, and generally softer global demand based on the US-China trade war. Manufacturers in Germany cut jobs for the first time in 3 years, with a number of firms indicating that some temporary contracts weren't being renewed. Now, why is this important? Because, as you may recall, I'm quite bearish on the euro, so this is a good opportunity to continue to short euros on pullbacks, i.e. moves higher. Then in Japan, we had the Tankan survey, and it's quite interesting because the large manufacturing index came in a 2-year low, and that moved dollar-yen above 111. It's quite odd, the reaction by the yen. I understand that usually we have some seasonality kicking in this week and next in the yen, but the Tankan survey was really bad, unfortunately. WTI trading above $60 this morning as the Baker Hughes rig count saw the largest decline in 3 years. We lost 69 rigs were shut down in the first quarter alone. So on top of that, some Iranian sanctions, some Venezuelan sanctions, that's all. Then we have the OPEC plus members cutting supply. The only thing bearish for oil, balancing those bullish factors that I just stated, is basically the continued increase in U.S. shale production. Nevertheless, I'm bullish on oil. I'm looking to buy bottom edges. Copper and iron ore saw a rebound this morning on strong Chinese PMI data, and Goldman upgraded their iron ore prices for the next 2 years. I think it's 2 years out, or was it a year out? Anyhow, an upgrade in iron ore and some risk sentiment improvement based on the numbers. You can see the numbers here. We had manufacturing PMI of 50.5 versus 49.6 forecast, non-manufacturing 54.8, so slightly higher, and then the Caixin at 50.8 versus 50.1 expected. So that's a positive risk tone, and we're seeing treasuries coming off the highs a little bit, some profit taking there because we've had a huge rally in U.S. treasuries, in German bunds. Well, that I'm still bullish on German bunds off of bottom edges as well, naturally. But we're seeing, at least for the equity market, a risk on tone. Strength versus weakness. What do we have in the G8? As we can see, bottom left-hand side, some pound strength, Aussie dollar strength, and then New Zealand dollar weakness. The weakest currency overnight or in the last 8 hours was the Japanese yen. What do we have coming up? I prepared 3 slides of importance. This coming week will be the Canadian dollar and the Bank of Canada. On Monday, we have the Governor Polo speaking on the topic, the importance of trade. Now, what we need to recall is that the Bank of Canada is stressing the importance that we try to move away in the Canadian economy from solely being an oil-based economy and more towards domestic demand and a tertiary economy, i.e. service-oriented. Nevertheless, trade is still of utmost importance to the Canadian economy as it stands. And in the last Bank of Canada statement, they made a reference. They made actually 4 references to trade. And one of the references was that trade tensions and uncertainty are weighing heavily on confidence in economic activity. So basically, the exact same point and case made by all Western central banks, all of them. We're hearing some economists exclaiming, hey, Americans, get on with it. Get on with it, sort this deal out with China so that we can go back to more certainty in the market. And the same message, I might add, would be reasonable for UK Commons to actually get their shit together and sort this Brexit mess out. Canada's trade deficit narrowed in January as oil prices rebounded. You can see that here, top line trade balance minus 4.2. That's still negative, but less negative than was expected. So we're hoping for some green sprouts there. Fridays, we'll have the job report. And it's interesting because when you look at it, anytime that the Canadian economy added 100,000 jobs or more over a 2-month period, and that just happened, I might show you the picture. Actually, it's a little bit early. We'll have a 85% probability that the following month we'll see positive jobs added again. And why is this important? Because the expectation is for a contraction of 10,000 jobs. So I don't think that's happening. The other thing that's interesting right now is Okun's law, which basically you can see on the right-hand side of this chart here. We have strong employment numbers in Canada, but weakening GDP, and that's actually a conundrum. And there's different explanations for it, which we don't have time to really get into right now. But it's quite interesting. So RBC is expecting another increase in average hourly earnings. That's important because it's inflationary pressure for permanent workers in the March data, which is coming up. And then last Friday, recall that we had real gross domestic product expanding at 0.3 for January, fully offsetting the declines in November and December of last year. And this rise was widespread. 18 of 20 industrial sectors were up. So we're seeing some positive development in terms of the GDP. I expect a headline beat for the jobs report on Friday. So hopefully we'll have oil strength, and then I'm bullish for the Canadian dollar off of bottom edges. What's happening in the US dollar? Friday, we have NFP, 170,000 are currently expected. That number is off of Reuters. You might not have it in your free data feeds. Versus February's 20K. 20K only added. That was the weakest job growth in a year and a half. Other data, though, suggest a surprise. And currently, some models are suggesting 181,000 jobs actually getting added. Why? Because the other data is we had weekly initial jobless claims suggesting that it's more positive. We had the Philly Fed survey and the Empire State Manufacturing Survey all indicating still robust hiring during the month. So that may suggest that we're going to get a higher number than 170,000. Average hourly earnings increased on a year-to-year basis in February to 3.4%. Inflationary pressure here was a new cyclical high, and it's expected to come in at the same count this time around again. And on Monday, today, we have retail sales with an expectation for month-on-month to uptick to 0.3. Gasoline for the month was up roughly 3%, while vehicle sales were flat at 16.6 million. It's important, though, because 2/3 of the U.S. economy is made up of the retail client and domestic demand. So all eyes on retail sales this morning. On Tuesday, we have durable goods orders, which is going to come in ugly. Why? One or the other trader may have heard of Boeing and the 737 MAX 8 debacle, and so orders slumped. They dropped off to just 5 plane orders in February, down from 46 in January. So Boeing is in a rut right now. It's actually, in my opinion, a longer term long off of bottom edges, because my expectation is that Boeing will sort this mess out. Core durable goods orders, on the other hand, are expected to come in higher at plus 20 basis points versus a contraction last time. And up in January for the first time in 3 months, only the second time in the last 6. So that's positive. If we see durable goods orders ticking up higher, you need to differentiate in the numbers. The core number is positive, whereas the headline number may come in negative, and then you always need to ask why, and obviously it's due to Boeing this time around. And then we have the Aussie dollar. There on Tuesday, we have the rate statement, and it's expected to come in unchanged, that the bank will leave the rates at 1.5%. But of utmost importance, will they also pivot to a dovish stance, as last week the Reserve Bank of New Zealand did? And look at the charts. For example, New Zealand's US dollar, it tanked heavily on that dovish pivot, heavily. So that's the main question. Might actually pay to stay up during that night for that session to see what the RBA will come out with. Westpac is expecting 2 rate cuts this year as GDP data for this last quarter of last year actually disappointed. It came in much lower with only 20 basis points of growth versus 0.5%, which was expected. And you can see here a continued decline since the beginning of since the beginning of 2018 when it comes to GDP growth in Australia. Now, on Tuesday, we also have the annual budget release. And that's important, in May, we have the general election over in Australia. So lucky for the politician, there's a 4 billion Aussie dollar surplus that allows for fiscal flexibility to fund tax cuts and spending. And that in turn takes pressure off of the RBA to cut rates. So don't be so quick to maybe jump to the conclusion that the other G8 central banks are cutting and pivoting to a dovish stance, that the RBA has to do the same. They might as well just remain for now in their neutral position, data dependent, and waiting for the general election to go through. HSBC reasons that the RBA would need to see a sustained unemployment rate marginally higher, i.e. materially around 5.5% in order to cut. And I added the picture here for you guys, bottom right-hand side, 4.9% currently. So we are far away from 5.5%. HSBC's base case is that the RBA will be on hold throughout this year and that the next move is likely to be up and then down, albeit not until mid-2020. So the Aussie dollar, after Tuesday, if they do not pivot dovish, given the solid Chinese PMI data, might actually be a long proposition off of bottom edges. It might be, completely dependent on what the RBA says. Consensus view is currently for the RBA to adopt an easing bias after the May election. All right. So what's the possible trade opportunity that I'm seeing for this week? There's one that I like a lot, and that is short New Zealand versus Canadian dollar. Why? We had a dovish pivot from the RBNZ last week. You can read it here. First sentence in their statement, the more likely direction of our next OCR move is down. And we have more and more tier 1 banks forecasting up to rate cuts this year alone over in New Zealand. I think last came JP Morgan on the wire stating they're expecting 2 cuts for this year. On the Canadian dollar side, on the other hand, we had stronger than expected GDP growth in January, last Friday, which fully offset November and December, 18 out of 20 sectors green. Unfortunately, mining and oil and gas extraction were negative. That's why I keep an eye on the oil price. If the oil price rallies, I'm pretty confident that the Canadian dollar can rally along. So the risk to the trade is a weakness in oil prices that would hit the Canadian dollar and or attention, cross flows out of Aussie this week, supporting New Zealand. I.e., if the RBA were to pivot on Tuesday towards a dovish stance, we would actually see the Aussie dollar tank and the cross flows would buoy the New Zealand dollar higher, and that would suck for my trade. So short New Zealand Canadian dollar. The other opportunity, thanks to Andrea, is actually short Euro, long Canadian dollar off of top edges. Why? Because European data, especially German manufacturing data, keeps coming in worse than expected. Guys, that concludes today's meeting. Let's see if we have some questions. Telegram real-time service. Yep, that's a good idea, Ulrich. I might have to check into that. No, I don't see any questions. So that leaves us at 25:27. And I wish you all a solid week. Let's make some money. Maybe RBA, potentially an opportunity for us to stay up and trade the momentum. And then if you want to, we'll see each other again next week, Monday. I appreciate you guys coming in. I appreciate Atmer for the opportunity. Trade smart, live free. I'll see you all later. Bye. Bye.
Die Stummschaltung ist aktiviert.